Long versus short stock. Purchasing stock. When it comes to stocks, the majority of investors only purchase shares when they think the business is doing well and that the stock price will increase. Being bullish on the stock is what this is called. Once you buy shares, you own them until you sell them. In the world of trading or investing, purchasing something is referred to as going long. The fact that there is no cap on how high a company's price might rise and that you can hold as many shares as you can afford makes owning stock exciting. If you sell the shares for more money than you purchased for them, you make a profit. You can sell the stock whenever the market is open. Of course, some stock comes with payments known as dividends, which is another way to profit from owning stock. Your maximum risk is whatever price you paid to buy the stock. Having said that, purchasing stock is fairly expensive, and you can only profit when the stock's price increases. The amount you pay to purchase stock is referred to as a debit. The money you earn is referred to as a credit when you later sell it. For instance, you would pay $10,000 as a debit if you purchased 100 shares of XYZ stock at a price of $100 each. You will be given a $11,000 sale credit if you sell those 100 shares for $110 each. In this case, you would make a profit of $1,000. Purchasing stock is quite straightforward, but shorting it, or selling shares to open, is more challenging because you never truly own it in the first place. As was indicated in the part before, if you purchase stock, you are long the stock because you anticipate an increase in its value. Your presumption is that you can buy now and hopefully sell at a greater price later, regardless of whether you like the firm or believe that some component of the company will drive the price up. You are the seller when you short stock, and this typically means you are selling stock that you do not own. Taking a short position would be advantageous when you believe a company is nearing its peak or may eventually go down. You would gain from a sell-off occurring. In the world of investing, selling something is referred to as being short. By borrowing the right to purchase shares, you can sell them at the current stock price when you short stock. In the ideal situation, you sell the shares at the current price and subsequently repurchase them at a lower cost. You would be bearish on the stock if you wanted the price to decrease. You could be asking yourself, how does it work? Something you don't yet possess cannot be sold. Correct. With the proper brokerage rights, you can sell something in the trading world that you don't already own. Selling a stock that you own is simple to understand because it would be the final transaction. The stock is already yours. Given how most markets operate, this is a straightforward notion to grasp. Because you don't own the stock while you're short, your broker provides you with the credit to buy stock with money you don't have. You start a trade by selling when you want to take a short position. You submit a sell order with your broker to open a short position, just as you would have done to open a long one. You have just received credit from your broker for the stock's current price. You simply receive the credit from the sale of the shares you just borrowed and take on the risk of the stock price increasing. You don't actually own anything. You would repurchase the exact same number of shares to complete this transaction later when the price drops. The term for this is covering your short. A debit is made against your account, and the stock is sent back to the broker at the same time. You keep the difference between when you sold it and when you rebuy it. In a short stock transaction, the broker lends you stock to sell on the market with the understanding that you will subsequently buy it back and return it to them. Because the difference would generate a profit, you want to purchase the stock again for less than you originally sold it for. You would incur a loss if you acquired the stock again at a price higher than what you borrowed for it when you sold it. It's crucial to keep in mind the risk involved in shorting a stock. Similar to stock purchases, stock shorting can be quite expensive. The fact that a stock's price has no cap is still true, but in this instance, it also means that there is no cap on the amount of risk associated with shorting a stock because you might need to purchase the shares back at a much higher, unforeseen price to conclude the trade. Meanwhile, you are paying interest to your broker for loaning you the shares. In order to profit from shorting stocks, you must be directionally correct, just like when you buy them. It is less risky to own shares because it costs nothing to own shares while waiting for the price to rise. Shorting stock costs you money in daily or weekly interest payments until you return those shares. In this example, if you short 100 shares of XYZ stock at $100 each and it climbs to $110 each, you would have lost $10 on each share of stock you shorted, for a loss of $1,000 overall. Thanks for watching. Please leave a comment or question below. Click like and subscribe if you found value in this video.